Kia ora, and welcome to the CoreLogic Property Market Update for Hongongoi 2022. We're halfway through the year, so it's a great time for a stock take of where the market is at. Anyone in the industry will tell you the housing market activity has gone quiet, and the data backs that up. The 12-month rolling count of residential sales peaked at the end of May 2021, with 114,601 transactions being completed. Since peaking, the trend has fallen away to 78,175 sales in the 12 months to the end of June 2022. That's a drop of 32%, or more than 36,400 deals. Tough for any industry sector connected to real estate activity, including real estate agents, conveyancers, building and pest inspectors, moving companies, and the list goes on. To put it into perspective, the 16,729 sales transactions recorded for the June quarter is only slightly more than the corresponding month during lockdown in 2020, and is the quietest second quarter of the year since 2008, in the immediate aftermath of the global financial crisis. Regionally, Tauranga and Auckland are furthest behind their long-term average for sales activity, at negative 35% and negative 33% respectively, with Wellington 29% down and Hamilton 27%. Dunedin is faring slightly better than the nationwide fall of negative 25% at 21% down, while sales volumes in Christchurch are down on the recent frenzied levels of the last 2 years, but relatively consistent with the long-term average, only negative 2% down. For a while, the restraint on sales volumes was due to a lack of listings. But of course, reduced sales activity is now a result of less demand, with buyers affected by restricted and more expensive credit. And with less competition and an increased stock comes less price pressure, or in this case, downward prices. Provisional figures from the quarterly CoreLogic House Price Index show nationwide values being negative 5.5% down since the end of 2021, with almost all main urban areas following a similar trend into the negatives. Gisborne may be lagging in the cycle, but has also shown weakness over the last quarter, down negative 0.6% from Q1. Double-digit falls are already evident across parts of the Wellington region, with Upper Hutt values down negative 14.3%, Porirua down negative 11.7%, and Lower Hutt down negative 10.2%. Values in Wellington City are not far off the same figure, being down negative 9.1%. In our largest city, Auckland, values are down negative 6.3% from peak at the end of last year, though there is some variability across the supercity. For the area defined as the Old Auckland City, generally within the Isthmus, values are down negative 7.9%, and for the North Shore, values are down negative 6.8%. Meanwhile, values in Manukau are down by a smaller margin at negative 4.5%. Despite the volume of sales holding up relatively well in Christchurch, property values are still showing some weakness too, down negative 3.2% from the end of the 2021 peak, no doubt affected by the significant change in sentiment, on top of availability of credit being reduced. As already mentioned, the other key feature of the weakening market is the increase in supply and more properties being listed for sale. This isn't because more people are choosing to list and get out of the market, but simply because properties are taking longer to sell. That knowledge is power for buyers who have taken advantage of their strengthened position, for those who can secure credit. The total number of properties on the market in Tauranga is 156% above the same time last year. In other words, 2.5 times as many properties on the market. There are also more than double availability in Wellington City, and just short of double in Dunedin too. Listings are up almost all over the country, so the 37% lift in Auckland and 43% lift in Christchurch are actually relatively constrained. With the balance of power swinging in favour of buyers, those unaffected by a more restrictive credit environment are enjoying better buying conditions now than in 2021. Although once you secure the credit from the banks, it inevitably costs you more than last year, so it's not all roses for prospective buyers. Nonetheless, deals continue to be made, mortgages continue to be secured, and transactions continue to be completed by all types of buyers. Although would-be first-home buyers have been affected by stricter deposit requirements and greater scrutiny on the expenses, which is now slightly relaxed, they're by no means out of the market. Almost 1 in every 4 sales went to this buyer group in the second quarter of the year. Investors too, facing an increasingly regulated market and changes to tax policies on top of inflationary pressures and a higher cost of credit, have reduced their levels of activity, but haven't left the market completely. With a seasonally normal flow of listings coming to market, investors don't appear to be selling or divesting in droves. And similar to first home buyers, they're still picking up about 1 in every 4 sales, taking a long-term view and more considered approach to investment yield. They could be entering a rental market going through a state of flux though, as the country faces an exodus of young people heading overseas for either their long-awaited OE or greater pay, and potentially reducing demand for rentals. Meanwhile, some of those unsuccessfully listed properties for sale are probably entering the rental market, increasing supply. On the flip side, it's possible would-be buyers may also continue renting, bolstering demand. The total number of properties listed for rent across the country is now 25.5% above the same time last year. In Wellington, there are 55.4% more properties available for rent. But the trend is not as universal for rentals as it is in the for sale market. Turning our mind to the future, and it seems interest rates will continue to play a key role in both the trajectory of the market and scale of change. Off the back of record levels of growth, fueled by all-time low interest rates, housing affordability is at or close to historically worst levels. Given the role interest rates play in determining mortgage serviceability, it's hard to see affordability, and thus demand for property, materially improving until interest rates fall or at the very least level off. With the Reserve Bank recently lifting the official cash rate by 50 basis points for the 3rd time running and not wavering from their guidance of more to come, it seems prudent to set expectations for a potential plateau for mortgage rates in 2023 at the earliest. Perhaps one element of hope for mortgage holders has been the recent competitiveness of the banks to provide attractive offers and the hope of winning customers from other banks. Enticing cashback offers, creative loans to make your home energy efficient, and a drop in the 2-year rate show they have a bit of room to move. The options are out there for anyone seeking to limit the size of their increasing mortgage payments. Indeed, another 1 to 1.5% rise in the OCR may not fully pass through to mortgage rates, given strong banking sector competition in a quieter market. But a popular 1-year fix may still rise towards 6% before peaking. As per usual, the market is an ever-evolving beast though, so make sure you stay on top of all recent developments by signing up to our regular releases. Follow us on social media and subscribe to the New Zealand Property Market Podcast, released every Monday afternoon. Mā te wā.